Hello friends, welcome back. So today we are going to discuss about liabilities and lease accounting. Before directly going to topics, let's start with a case. Imagine you are working in a company called Orbit Logistics, a firm that delivers package using a fleet of electronic vans. To expand your company, Orbit leased 50 new vans instead of buying them. The second thing, to keep customers happy, they offer a 3-year warranty on their custom delivery software. So, two cases are there. First thing, to expand their operation, they leased 50 new vans instead of buying them. That's what we called leasing or renting. And also, to keep their customers happy, they are now giving 3 years warranty on their custom delivery software. So, the warranty is a liability for the company. So, in this today discussion, we are going to deeply into how we can account these liabilities and the lease as per US GAAP. The first thing, let's start with the current and long term liabilities. We discussed it multiple times. What is current liability? Current liabilities are the liabilities which has to be settled within 1 year, and the long term liabilities which have a maturity period more than 1 year, that is long term liabilities. So, let's start with the treatment of warranty. How we are going to treat the warranty? What is warranty? Warranty means we are giving an assurance to the customer that if there is there any damage to the product, we will replace it or we will repair it for a free of cost. That is normally warranty. So, there are two methods to account the warranty. The first thing, it is accrual method. We have a core principle, that the accrual principle. What is accrual principle? And the matching principle in accounting. What is matching principle? Once you record a revenue today, you have to record the corresponding expenses or cost related to that revenue in the same period. So, to compare with the matching principle, normally we are using accrual. That means if you sell for 100,000, as per your experience, you are assuming that there is a 2% of return chances are there. So, you have to consider 2% mean 2,000 as your current or warranty liability on that period, even if it is not occur. That is accrual method. That means we are estimating that cost and record an expense and a liability at the same time of sales. We are not waiting to getting return from the customer. Once you made the sales, in the same period you are creating an expense and a liability to match with the matching principle, that is accrual method. So, this is the method that is allowing as per US GAAP, and the second method is cash basis. Cash basis mean if the actual repairs or actual return happen, that times only you are recording the transaction, that is cash basis. Normally, US GAAP is not allowing to follow the cash basis, it should be accrual basis to comply with the matching principle. That means, once you record a revenue, you have to record the corresponding expenses related to that revenue in the same period, that is matching principles. So, the accrual method is the only method now the US GAAP allowing to account the warranty. This is the important point here. A liability is a present obligation of an entity arising from past event, the settlement which is expected to result to outflow of and resources, that is the liability. So, again when it comes to warranty also, this is the same definition. It is arising from the present, is a present obligation of an entity arising from past event, the settlement is expected to result an outflow of the resources. As an example, if a company sells separate extended warranty, that is a service type warranty. There are two types of warranties are there. One is it is attached with the product. I am selling an electronic product, suppose for a television. If I am attaching that warranty with that product, that is the normal warranty. If you are selling warranty separately, that is service type warranty. You must, so here the treatment is entirely different. If it is a service type warranty, you have to consider that warranty, that sales amount as a unearned revenue, and it has to be recognized, that income has to be recognized over its useful life of that contract rather than expensing it at once. So, this is a treatment for the warranty, how you are going to treat the warrant. So, it should be accrual method, and the other thing, if you have selling warranty separately, that has to be considered as a service type warranty, not a regular type warranty. So, let us move into lease. What is lease? This means simple term we can say as renting. Suppose you need a machine to produce a specific product, and you have two options. That means buying that machine by paying the cash or by paying the money, and the second option, there are some service providers, they are leasing this type of equipment, they are providing lease service for this type of equipment. You can lease that equipment from that providers, that what we call leasing. So, there are two types of lease are there, finance lease and operating lease. Finance lease is mainly finance lease means it's a type of installment purchase, and the operating lease is a pure rental. Finance lease means it's a type of installment purchase, and operating lease it's a pure type of rental. So, let us look into the differences between the operating lease and financing lease. The ownership transfer, when it comes to financial lease, usually transfer to lessee has bargaining purchase option. That means the lessee or has normally in the financing lease, the two categories are there. First thing, you are transferring the ownership to lessee, or the lessee has to bargaining purchase power option at the end of the contract. When it comes to operating lessee, it still remain with the lessor. The ownership, then the lease terms. If a lease covering 75% or more than that of that asset useful life, it is a finance lease. The operating lease, it is less than 75% of the asset life. Suppose you are assuming an asset life is 10 years, if the lease period is covering 7.5 years or more than 7.5 years, it is a finance lease. If it is less than 7.5, it is a operating lease. Then the present value. Present value of payment is substantially all of the fair value 90 plus above. Suppose your total lease payment value, if you are calculating the present value of all your lease payment, it is more than 90% of the asset fair value, then it is a financing lease. Suppose your total payment, you calculated your total payment, present value of your total payment is 91,000 and the fair value of that asset is only 100,000. So, in this case it is a financing lease. At the same time, if it is less than 90%, that means your total present value of complete lease payment is 75,000 only and your fair value of the asset is 100,000, then it is a operating lease. Then when it comes to balance sheet, now the financing lease and operating lease, both lease has to record as a asset, as a right of use asset and lease liability. So, previously the operating lease you can just record as an expenses. Under US GAAP, now both the financing lease and operating lease is mandatory to show in the balance sheet, as in the asset side it will show as a right to use of asset, and in the liability side it is a lease liability. Then when it comes to income statement, in the financing lease the payment will be the interest expenses and you have to amortize expenses. Then when it comes to operating lease, it is a single lease expenses that you have to show in the income statement. So, these are the key differences between the financing lease and operating lease. Here the important things is, if your lease meet any of these criteria, this financing lease criteria, this has to be classified as a financing lease. to recognize or to classify one lease as a financing lease, you have to meet only at least one of these criteria. Any of these criteria or multiple criteria like the ownership transfer, lease term, present value, balance sheet and the income statement, if you meet any of these 5 criteria, it has to be classified as a financing lease. If it is meeting any of these criteria, it is an operating lease. So, this is an important point. If your lease meeting any of these financing lease criteria, it has to be recorded as a financing lease, and if it is meeting none of the financing lease criteria, it has to be recorded as a operating lease. Then let us move to income tax or the deferred tax. What is deferred tax? Deferred tax mean it is the difference between your, suppose for the financing reporting purpose you are following one depreciation method, and for your tax reporting purpose you are following a different depreciation method than financial reporting method, just assume. So, what will happen? So, there will be a difference between the net income in the financial record and as per the tax report, there will be a small differences. And just assume another case. Suppose some of the expenses that you are recording in your financial report, but that is tax exempted in the tax record. So, in this case also there will be a slight difference between the net income between the tax record and the financial record. So, in these cases your tax liability will be different in the income statement as per your financial report and the income statement as your tax financial report. So, that difference what we called as deferred tax. So, there are two types of deferred tax are there. First thing is the permanent differences and the temporary differences. The permanent differences mean, suppose some of the expenses that you reported in your income statement for the financial report and the same expenses like some municipal bond interests or the fines and penalties that you removed from your tax report. So, in this case there will be a permanent difference between your income statement as per your financial reporting and as per your tax reporting. That difference what we called as permanent differences. Then the temporary difference. Temporary difference mean, suppose you are following a specific depreciation method for your tax reporting purpose and another method for your financial reporting purposes. So, in this case there will be a temporary differences between your tax calculation as per your income statement for the financial reporting and as per your financial statement as per tax reporting. That what we called as temporary differences. These temporary differences will sort out by the next period or in the coming period, but the permanent differences will remain for the financial report forever. So, then deferred tax liability and deferred tax asset. Deferred tax liability, suppose you paid a tax today which is less than your book income, then there is a deferred tax liabilities. Then the deferred tax asset mean you are paying more amount as tax than your book income, that is your deferred tax asset. So, when it comes to deferred tax liability, suppose in your financial reporting you are using accelerated depreciation method and for the tax purpose you are using straight line depreciation method. So, there will be a deferred tax liability, which means you are paying less tax when it is compared to your financial reporting. So, that is deferred tax liabilities. At the same time, suppose you recorded a warranty liability, warranty expenses, while when it comes to tax reporting it has to be deducted, some cases it has to be deducted after only when it is paid, but as per your financial reporting you have already acquired that expenses. So, there will be a difference in warranty expense in this case. That means same, if the warranty expenses are deducted only for tax, when it is paid, but expensed for the book now. So, the warranty expenses in the as per your tax report you have to consider only after payment, but as per your financial report you already considered that warranty expenses. So, in this case what will happen, you paid more taxes today than your book income. Yeah, this is the case. In this case what will happen, your tax income will be higher than your net income. So, that means you paid more taxes than your book income. So, this is the case where the deferred tax asset will come. Deferred tax liability mean you paid less tax when is compared to your book income, and the deferred tax asset will arrive when you paid more taxes than your book income. So, let us look into some cases. The first thing is warranty liability. Orbit Logistics sold 500,000 of a software in December. They estimate warranty cost at 2% of sale. During December, the actual spend is 3,000 on repairs. So, how you will treat this situation? First thing, they have to record warranty expense 10,000. That means you made 500,000 as sale and you have to consider that estimated based on the actual sales. It will be 10,000. So, at the end of the year, the warranty liability will be 7,000 and this actual spend you have to reduce from this 10,000. So, once you made sales, your warranty liability will be 10,000. Once you receive that warranty claim, you can reduce that 3,000 from this warranty liability. So, the actual spend, the actual warranty liability at the end of the period is 7,000 only, and your warranty expense is 10,000 for the period. So, let us move into second case. Orbit leases a drone for 4 years. The drone has a useful life of 5 years and there is no purchase option. The first thing, it is drone has leased for 4 years and the actual useful life is 5 years only. So, this lease has to be treated as a financing lease, because if you meet any of the financing lease criteria, you have to classify your lease as financing lease. In this case, your total useful life is 5 years for that particular asset and you are going to lease for 4 years. So, that means it is 80% of useful life you are going to lease. So, what is your threshold? It is only 75%. If you are leasing the equipment more than 75% of its useful life of asset, then it has to be treated as a financing lease. So, let us move into third case. Orbit bought a machine for 100,000 and its book depreciation is 10,000 and tax depreciation is 20,000, because for the tax purpose they are using accelerated depreciation. Then the tax rate is 21,000. So, there will be a temporary difference of 10,000 in the tax, because the book depreciation is 10,000 only and the tax depreciation is 20,000. So, in the tax calculation base there will be a 10,000 depreciation. So, in the tax depreciation is higher than the book depreciation, because for the tax purpose the depreciation is 20,000 and for the book depreciation it is 10,000 only. So, the Orbit is a saving tax now, because as per the tax depreciation it is 10,000, it is 20,000, that 20,000 they can reduce from their total income while calculating tax liability. So, there will be a saving of 10,000 into 21%, that means 2,100 saving will be there. So, this will be a deferred tax liability for this company, because as per book it is the tax liability, as per the book depreciation it is 10,000 only and the tax depreciation is 20,000. So, while calculating the taxable income, you are considering that 20,000 as your expenses. So, definitely your tax liability will be lower in this case. So, that means you are paying, you are saving tax now, that means you are paying the taxes that lower than actual books of account. So, in this case there will be a deferred tax liabilities of 2,100. So, let us move into multiple choice question practice. A company utilized the accrual method of warranty accounting. During year 1, the company made sale of 1 million and estimated that 3% of sale would be eventually result in warranty claim. In year 1, there will be 12,000 was actually spent on warranty repairs. What is the amount of warranty expenses reported on the income or on the year 1 income statement? So, here the question is very straightforward. What is the total reported, what could be the total reported warranty expenses for the year 1? So, their total sales is 1 million and estimated warranty expense is 3% of the sales. So, it will be 1 million into 3%, that means 30,000 is your warranty expense that you have to report in year 1. So, option C is the right answer here. That is your warranty expense that you have to show in your income statement for the year 1. Let us move into second question. Under accounting standard 842, which of the following is a characteristics of an operating lease for the lease? The lease contain bargain purchase option. Option B, the lease term is for 90% of asset economic life. And option C, the lessee recognize a single expense on straight line basis over the lease terms. Option D, the lessee recognize interest expense and amortization expense separately. So, which of the following is a characteristics of operating lease? If the lease have bargain purchase power option, it is a financing lease. The lease terms is 90% of asset economic life, then it is a financing lease. Option C, the lease lessee recognize the single expense, lease expense on a straight line basis over the lease term. This is the feature of operating lease. So, option C is the right answer here. You can see the answer and explanation here for the question 1 and 2. Here you can see all other criteria are the criteria for the financing lease, not for the operating lease, except option C. So, this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.